Hey everyone, and welcome to This Explainer. Today we are tackling a topic that is fundamentally reshaping the financial back office, the highly complex and, frankly, rapidly evolving world of crypto accounting and taxation. Now, if you're managing digital assets for a business or you're a serious investor, staying ahead of these 2025 and 2026 IRS rules isn't just a good idea, it's absolutely critical to your bottom line. The days of just treating crypto like a fun side hobby on your tax returns, those you're completely over. Today we're going to break down the technicalities of asset classification, cost basis rules, and the enterprise tools you actually need to stay compliant. Okay, let's dive into this. Here's our rules of the game framework for today. 1. The crypto balance sheet. 2. Cost basis and IRS rules. 3. Tax loss harvesting. 4. Crypto wash sales. And finally, 5. Enterprise software solutions.
Section 1. The crypto balance sheet. Let's get our foundational baseline set.
First off, we've got to completely shatter a really common misconception right out of the gate. Cryptocurrency is not cash, and it is certainly not a cash equivalent. Even though it literally has the word currency in the name, you can't simply plug it into your standard cash conversion cycle. Unlike fiat currency, digital assets lack FDIC protection, they aren't government-issued legal tender, and, well, their wild volatility completely disqualifies them from being categorized alongside stable assets like treasury bills or CDs. If your company accepts crypto as payment, you have to treat it more like an investment or property, definitely not digital money in the bank.
So, if it isn't cash, what exactly is it? Well, it depends entirely on your business model. It's kind of like a giant puzzle. If you're a non-crypto company, say a company like Tesla that just buys Bitcoin to hold on its balance sheet, you must treat it as an intangible asset. That means on your income statement, you can recognize impairment losses when the price drops, but no way can you recognize unrealized gains if the price skyrockets, not until you actually sell the asset. On the flip side, if you're a financial firm trading crypto as your core business, you treat it as an investment, which allows you to reflect fair value changes, both gains and losses. And finally, for crypto miners, the coins they generate are treated as inventory, recorded at the lower of cost or net realizable value. Getting this classification right is step 1 to true compliance.
Moving right along to Section 2, Cost Basis and IRS Rules.
Now, in the crypto space, cost basis is where so many tax returns go completely off the rails. By default, the IRS applies a method called FIFO, first in, first out. It's super simple. It assumes the very first units of crypto you bought are the very first ones you sell. But in a rising market, FIFO pulls your oldest, cheapest units first. And you know what that means? Massive tax bills. The permitted alternative, however, is called specific identification. This is where you, the taxpayer, get to pick exactly which units you are selling. By using specific ID, you can utilize strategies like HIFO, highest and first out, to intentionally sell your most expensive units and dramatically minimize your taxable gains. And this brilliantly illustrates exactly why your choice of cost basis matters so much. Just picture this. You sell one Bitcoin for $50,000. Under the default FIFO method, maybe it pulls a Bitcoin you bought years ago for $20,000. That leaves you with a staggering $30,000 taxable gain. But if you apply specific identification and use a HIFO strategy, you can specifically choose to sell a Bitcoin you bought more recently for, say, $40,000. Look at that difference. Your taxable gain drops to just $10,000. It is the exact same economic transaction, driven entirely by your chosen cost basis method. But here is a critical warning, and honestly, why you need to pay close attention to this right now. Starting with the 2025 and 2026 tax years, the IRS is cracking down hard. To use specific identification, the specific tax lots must be identified before the trade is executed. Let me repeat that. Before. You absolutely cannot do this retroactively when you file your taxes next year. This strict timing requirement effectively bans those after-the-fact, automated algorithmic optimization methods like Opti or Zero that used to run at year-end. If you don't pick the lot before you hit sell, you are stuck with FIFO, for sure. So if you're going to opt out of that default FIFO method, you must have an ironclad audit trail. Here's your checklist. For every single transaction, across every single wallet and exchange, you must consistently track the exact date and time of acquisition, your cost basis, including transaction fees, the exact date and time of disposition, how the quantity maps to specific lots, and consistent wallet identifiers. If the IRS knocks on your door and you don't have this granular, real-time data ready to go, they will revert your returns to FIFO, and you're going to owe the difference. All right, let's jump into Section 3, Tax Loss Harvesting. The magic number here, folks, is $3,000. When you harvest a crypto loss, you first use it to offset your crypto or stock capital gains. But what if your crypto portfolio really took a hit and your total capital losses for the year actually exceed your capital gains? Well, the IRS allows you to deduct up to $3,000 of those excess losses directly against your ordinary income, like your W-2 salary or freelance earnings, every single year. And the absolute best part, any losses beyond that $3,000 limit carry forward indefinitely into future tax years.
Section 4. Crypto wash sales. Let's talk about a massive tax loophole. Now, what's really fascinating about this is the stark contrast between traditional markets and crypto. In the traditional stock market, there is a strict wash sale rule. If you sell a stock at a loss, you are completely forbidden from buying that same stock back for a 61-day blackout window. Otherwise, you lose your tax deduction. But because the IRS currently classifies cryptocurrency as property and not a security, the wash sale rule literally does not apply to digital assets right now. You are legally allowed to sell your crypto at a loss and immediately repurchase it without losing a single dime of your tax deduction.
Let's walk through how this actually works in practice, because the physical execution is incredibly straightforward. Step 1, you scan your portfolio and identify a position currently sitting at an unrealized loss. Step 2, you sell the asset. Bam! This officially locks in the capital loss for your tax return. Step 3, you instantly repurchase the exact same asset at the exact same price. Your overall market exposure hasn't changed one bit. You still hold the asset, but you've now pocketed a highly valuable tax deduction. You simply cannot do this with Apple stock. However, you need to act on this while you still can. This exemption is basically a legislative accident, and the window is slamming shut fast. Congress has been trying to close this loophole for years, and the IRS is already preparing the infrastructure to tax it. Form 1099-DA, which brokers are required to use starting January 1st, 2026, actually already includes a specific box labeled Wash Sales Loss Disallowed. The reporting field is already there, guys. They're just waiting for lawmakers to flip the switch. So the smart move is to utilize this exemption now before it's gone.
Finally, Section 5. Enterprise Software Solutions. To manage all this madness, the crucial point is choosing a software platform that matches your specific business complexity. Let's look at 3 top-tier platforms ready for 2026. First up is Cryptio. This is an incredible enterprise-grade platform, absolutely perfect for companies needing deep integration with traditional accounting systems like Oracle NetSuite to stay audit-ready. Next is Trez Finance. Trez really excels in institutional reconciliation. If you've got massive transaction volumes across multiple blockchains, their AI-powered tools and proof of funds reporting are a real game changer. And then we have Bitwave. What sets Bitwave apart is how it connects crypto with traditional business workflows, stuff like accounts payable, accounts receivable, and processing stablecoin payments directly into your ERP.
Which brings us to our ultimate takeaway for today's explainer. As these rules tighten and the IRS demands more granular, upfront data, you really have to ask yourself, is your financial stack truly prepared for 2026 IRS scrutiny? And are you optimizing your portfolio right now before that wash sale exemption window completely closes? Take the time to evaluate your crypto accounting infrastructure today, because in this space, compliance and strategy are the exact same thing. Thanks so much for hanging out with me for this explainer, and keep learning.